I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. It's really what makes us different than anyone else.
What happens if people move money into treasuries and the Fed does a currency reset or moves into hyperinflation?
Interest rates print the market value of the bonds, okay? Hyperinflation would happen really fast, just like that. So you'll see a huge spike up in interest rates, and the value of the bonds will just go to pretty close to zero. And then when they actually do currency reset, even closer to zero, because now all confidence is lost in the currency. So they lose all of their value. And even just in this past week or two, what we've seen are interest rates really going up as the bond vigilantes, the bond traders, are so uncomfortable with the level of debt that that our government is growing, and even more debt. And there's huge concern out there for who's going to buy all that debt. It was interesting because I was listening to Bloomberg, and they were talking about 401ks, pension plans, all of these institutional investors that invest your money. So you just make your contribution and you trust that they're going to do what's in your best interest. But they are really counting on the public to pick up the slack, because foreign governments have pulled back from buying treasuries, and some, i.e. China, might even be selling into this market. The Federal Reserve is also trying to run off the treasuries on their balance sheet, and so they are not net buyers anymore. So, what happens when you have more sellers than buyers? Guess what happens? Interest rates go up, and the principal market value of the bond goes down. So yeah, no matter what, when interest rates go up, the principal value goes down. The difference between inflation and hyperinflation is the speed. So I would say the same thing is true here. It's the speed of that loss.
So you say that wealth never disappears. Is a currency reset a way to create a wealth transfer? And if so, what does that look like?
Yeah, 100%. And just look at this inflation. And have we not heard about that K-shaped recovery? Have we not heard about income and wealth inequality? Inflation itself is designed to transfer the wealth from the many, from the public, to the few, to the 1%. If they do it slowly, it still happens, hence the income and wealth inequality. And when you look at the charts and the graphs, that really began like in the early 80s as we were transitioning into this debt-based system. But it's the corporations, including the banks, which are just private corporations, that actually get access to that money first. And by the way, they actually get it cheaper than the federal government, whose taxpayers are supposed to repay that money. But whoever is the closest to the central banks, if that's the hub, whoever is closest gets the money first when it has the most value. And then by the time it trickles down to the public, it has a lot less value. So no matter what, yes, this was designed to be a wealth transfer mechanism right out of the chute, because they knew that not one man in a million understands inflation. And it's kind of scary to have Jerome Powell and Christine Lagarde, head of the Federal Reserve and the ECB, admit that they don't understand inflation. That's very unnerving, really, since they're the ones that are supposed to be managing it.
What are some examples of those close entities to the central banks getting the value first and then the trickle down, like you mentioned?
Well, the commercial banks, right? And like I said, they get the debt, they can take on debt cheaper than the U.S. government. So it's really the private corporations that have access to the central bank. I mean, look at who got bailed out. Apparently hedge funds can be part of that as well. And those in Silicon Valley, because weren't they the ones that got bailed out in March and April. So they are the ones, it's Wall Street that is the closest to the central banks, not you or me. And the trickle down, this is the trickle down theory where the theory was if they give the money to the wealthy, then the wealthy will spend it and it will trickle through the economy, but it really doesn't work. It doesn't work like that, right? But that's the premise on which they created an awful lot of monetary policy and who was going to get the money. And look what happened in 2008, right? 2008, it was all the banks that got the money. They got bailed out. That's why in 2020, they gave some to the consumer, but because they wanted the consumer to be able to continue to consume. But who really got the money from those bailouts too? So it should be pretty obvious that it's Wall Street and those minions that actually have access to the central banks and the central bank. Money for free, right? Not you or me. We don't have access to that window. So
in a currency reset, does the wealth transfer then just happen faster in those scenarios?
Yes, exactly. But what also happens, if you look at where we can see a pure supply-demand market is in those collectible coins that are up at the highest level, those rarities, right? And we can see, and the central banks loading up on those gold, on gold. Why? Because when they do that reset, they take this that's all intangible value because it's used, or tangible value, because it's used in every sector of the global economy, and they revalue this stuff against, because this has no tangible value. It's used in one area, and you can't eat it. No, you can't eat gold, but you can't eat this either. This may be able to feed you because it can still buy food and other things that you need because it has the broadest base of demand. This will lose all demand. If we look at Venezuela, the bolivar has more value as a napkin for the empanada than it does to purchase anything with.
Can you explain counterparty risk as it relates to treasuries versus gold?
Well, yeah, counterparty risk as it relates to treasuries or anything else, that is a contract. And any contract is only as good as the other party on that contract. So with all of the dysfunction that we're seeing in Washington and the shutdown that almost happened, but boy, they pulled it out in the last hour, all they really did was kick that can down the road till before Thanksgiving. What do you think is going to happen when we get toward Thanksgiving? And we just saw, what we're seeing is a lot of infighting in our government. And it's not just party to party, it's within the parties themselves. That's hugely dysfunctional. And it was bandied about when we hit the debt ceiling, which has just been suspended, right? It was bandied about not paying our bills. Well, would that really be so bad? Yeah. So if they decide to test that, you got to ask, are they going to test it out in the marketplace into other countries, or are they going to test it domestically to holders of treasuries here?
And counterparty risk as it relates to gold, tangible versus ETFs and things like
Well, there's no counterparty on this, right? So the Bank for International Settlements, which is the biggest bank in the land, the central banker's central bank, has stated gold is the only financial asset that runs zero counterparty risk because you hold it and you own it outright. There's no strings attached to this ounce of gold. Whoever holds this owns it, period. And that's why it runs no counterparty risk. I can do anything I want with it. It's virtually invisible, even though you can see it and you can hold it. But there is no counterparty. I don't have to worry about whether or not the government is going to repay on this coin. No, it is self-contained, no counterparty risk. Nobody else is involved in this, just me.
Is that the same for ETFs?
No, that is not the same for ETFs. Actually, an ETF would be layers of counterparty risk because you have the entity that brings the ETF out. That's one company, and if they don't want you to have your money for whatever reason, because typically ETFs do not keep a lot of cash. So if there's a lot of people that are demanding to sell it, they could run into some problems and say, nope, we're not going to liquidate. That's counterparty risk. It would also be layers of counterparty risk inside of it because it's stocks or bonds or derivatives that are inside of this ETF. So that's why I'm saying what you've got inside of an ETF or an ETF or a mutual fund or an annuity or any of those products is not just one layer of counterparty risk. Like if you own a treasury bond, your layer of counterparty risk is whether or not the government's going to pay it. When you have any of those Wall Street products, you have layers because it's not just whether the entity that issued it is going to pay it, but it's also all of the stocks or bonds or derivatives and all of that's total counterparty risk that you don't even have anything to do with, right? So it's layers of counterparty risk, and it's not just ETFs, so we need to be really clear on that. That's mutual funds, that's annuities, that's ETFs, it's all of the Wall Street products.
Do you believe there's more counterparty risk in treasuries or ETFs and financial products?
Well, there's more counterparty risks in ETFs because of the layers or the other financial mutual funds, things like that. And of course, the U.S. government, at least at this point, although that's what Wall Street is having a problem with right now. That's what the bond vigilantes are having a problem with right now. So it's one layer versus multiple layers. Either way, it frankly would not really be a big surprise to me if this next test of the debt ceiling or anything like that is going to maybe our government will say, yeah, maybe we won't pay the domestic bonds. We'll pay the foreign bonds so foreigners keep buying our bonds. But what are you going to do if it's inside of your retirement plan and they decide not to? There's nothing you can do.
So people that are interested in the upside of treasuries are betting on a crisis for that upside?
Yeah, absolutely. Because what they're betting on is right now the interest rates are up there, right? Like 4.5%, 5%. I think the 10-year for a minute broached 5% today. But, and the principal is down here. So what they're counting on is a Fed pivot, right? So a big crisis that would be big enough to justify the Fed stepping in and dropping interest rates down. So what you're really doing is risking your principal for this teeny bit of pickup. I mean, it's interesting to listen to the talking heads talking about, are you getting paid enough for the risk that you're taking? Because what you don't realize is it's not just this risk, it's also the value of this risk, right? And they've been eroding that for, since they started this experiment in 1913. It sped up in 1971, and now we're at the end. And so if you think of it like a drain, and you know how water will spin around and the sink is full with the water and it kind of goes slower, but then as more and more water goes out, it goes faster and faster and faster and faster until all the water goes down the drain. Well, the same thing is true, you could say, with purchasing power. When they could maintain it, meh. And I say meh because they use all sorts of accounting tricks to make the inflation rate look like what they want it to look like. But, when they could keep it somewhere around 2%ish and people believed them, right? Then it was like going slowly around that drain. But when you look at the purchasing power chart from the Federal Reserve, you can see how much more quickly, particularly since 2008, that loss of, and then 2020, that loss of purchasing power, has, because the only thing that they have in this part of the plan is to repay the debt with dollars that have less and less and less value. And they push that out into the public too. If you think about when you bought your first house and you're going like, oh my God, that mortgage payment is so high, I hope I can do it. But then over time, as your wages got inflated, you weren't really making more money, but nominally you're making more money. It got easier and easier for you to service that longer term debt, right? Well, that's the same plan that the government has. But now we're at the end, and you know, your house, I mean, you could rent out the room, you could generate food, you can make that a self-liquidating debt. You can generate income from your house. There are different things that you can do. But with the government, when they're borrowing money to fund their salaries, you know, to fund just the government expenses, they're spending that money. That's not coming back. That is not self-liquidating debt. That is simply debt. And it is there's no way that they can repay that. But right now, the fear is that they're going to have one heck of a time rolling that debt over. We are in that place right now. It's not a good place to be.
So when the gold price is manipulated downward, do smart money and central banks typically buy or sell during that time?
They're buying, and they're buying big time because they know that they're manipulating the markets, and we're seeing something very different in the physical markets. And they're accumulating because they know that the death of all fiat currency, this system, I mean, I can't tell you the exact moment that it's going to happen, but I can tell you without even one little doubt in my mind that we are closer to it than we are further away from it, for sure. It can happen anytime now. It's too fragile a system.
Thank you.
You're welcome.